Welcome to Close of Business. I'm Alicia Barry. The collapse of First Guardian and Shield investment funds has left thousands of investors demanding answers over a missing $1 billion. The head of a company that licensed advisors to sell the failed schemes says he's got nothing to answer for. We'll talk to him shortly. No charges have been laid, but the corporate watchdog says it rejects suggestions it missed any red flags and is still on the case. Nassim Kadem has been investigating.
When Mel Wallers learned she could lose her retirement savings, she almost took her own life.
It's tough mentally, and I went to a really dark place because of this and almost did something really stupid, and I don't want to, and I've spoken to other people who considered what I considered.
Lured in by telemarketers promising high returns, she was put in touch with financial advisors at a firm called United Global Capital, which has since been wound up.
It's just a cookie cutter approach. Everyone has the same wording.
The advisors convinced her to move her money, $370,000 from industry fund Hostplus into a self-managed option.
They were very pushy. They were very good salespeople, and I don't think I'd ever encountered, that kind of sales tactic that they were using.
Her money was put into a managed investment scheme called First Guardian, which has since collapsed. Its directors are being accused by Australia's corporate watchdog of using the cash to buy fast cars, pay for mortgages on lavish homes and sending it overseas. The allegations have been filed in court but are yet to be tested. Another investment scheme, Shield Master Fund, was put into liquidation. The demise of the two saw the savings of 12,000 Australians evaporate. It was financial planners that channelled investors into these funds.
So I'm heading now to Interprac to interview their managing director, Gary Kroll. Now, Interprac was the licensee that many of the financial planners that were pumping people into these products, First Guardian and Shield, were sitting under. So I'm going to be putting some questions to Gary about their role in all of this.
Ferras Merhi's advice firm, Venture Egg, was
Yes.
bringing in hundreds of clients a month into Interprac.
Yes.
Did Interprac increase oversight when it saw these high volumes coming in?
Yeah, no, absolutely. We increased oversight.
But what was the oversight, Gary? Can you explain how that looked?
Yeah, no, absolutely. Regular training of all his staff, regular reviews of his statements of advice.
And what was actually going through your mind, Gary, when you saw, more than 100 clients or hundreds of clients coming in every month and all this money coming in?
So what was going through my mind was that Australians are unhappy with the superannuation system. We're finding people who are unhappy with the system and selling leads to advisors, and advisors would then give them appropriate advice. I thought that was good.
You had put First Guardian and Shield on your approved product list when there was no history of performance and very little research apart from SQM.
Yeah, well, our standard process is to use research houses. A 3.75 rating for a First Guardian or a Shield for a fund with less than 3 years' experience is as high as you will ever see.
3.75 star rating is an acceptable rating, but it's certainly not the best.
No.
Why allow so many financial planners to pump so many people into these two products specifically? Why didn't you review that list and check that list to make sure it was suitable for people?
It's not our role.
In July 2023, Interprac paused inflows into First Guardian and Shield. Why did you do that?
So there's a number of reasons. We were in discussions with ASIC in 2023.
So that was 2 months after the pause. You allowed advisors to put more client money into First Guardian.
Yes.
So why? Why did you allow this to happen? If all the oversight you were saying was being undertaken, if you were having these conversations, Why allow that to happen?
We thought that the First Guardian funds were what they were reported to be.
ASIC now has 25 active investigations into numerous parties linked to First Guardian and Shield. 6,000 investors who put cash into First Guardian are owed $445 million. And the 5,800 people who invested in Shield are staring down losses of up to $480 million. In a parliamentary committee hearing, ASIC's deputy chair revealed 140 licensed financial advisors were being examined.
ASIC was warned as early as January 2021 that there were issues with the management of First Guardian. Why didn't ASIC take actions to close the fund sooner?
We're already aware about issues associated with cold calling models, with what we might call sort of cookie cutter advice. And took action, investigated, looked at those things very closely, and was certainly not put on notice of any issues with the fund itself.
So ASIC didn't miss the red flags?
No, we don't think we missed red flags. You know, there are thousands and thousands of managed investment schemes at any particular time.
Both investment funds were accessed through well-known superannuation platforms, including Macquarie, Diversa, NetWealth and Equity Trustees, the last of which ASIC is now suing.
The superannuation funds have had a huge role to play here. They put these products on their shelves.
The question with the super funds as well is what due diligence was done on those products before they went onto the platform. Was there more that those trustees could or should have done to investigate whether those products were appropriate or not?
Do you think there's a case for investors to get compensation from the super trustees that ran the platforms?
We are certainly exploring every option that we can in relation to whether it be super trustees or other options as to whether and how we can get money back to these investors who, you know, in our view have been so wronged.
Gary Prince turns 62 next month and stands to lose almost $700,000 of his superannuation.
Every minute of every day and night, it haunts me.
Telemarketers convinced him to use financial advisors at United Global Capital, who pumped his funds into First Guardian.
I wanted to invest in what was called a balanced portfolio, so a moderate risk. As it turns out, the monies that were rolled over were put into various investments that, frankly, I would never have had a bar of.
Dylan Greenway is helping First Guardian and Shield investors lodge cases with the Australian Financial Complaints Authority in the hope of recovering their money. As he trawls through the contracts investors were told to sign, alarm bells ring.
I've got one statement of advice that suggests the investor will receive a 15% return in perpetuity on their super. So it says today you've got $90,000 in super. In 25 years that will be worth $1.6 million. So very high promises of returns is a red flag. The other issue is they're putting all the investors' funds in one asset.
I mean, the other issue is that Interprac knew that Ferras was moving clients into investments without their consent and approved the practice even after. So this is where you were basically allowing advisors to issue records of advice saying that if you don't hear back in 7 days, we'll assume you've given consent.
That is not correct.
That never happened?
You said that we knew that. We did not know that. We don't approve negative consent. The issue is clients need to get their money back.
I think everybody wants to see that. But
yes.
How was this happening? How were your advisors issuing records of advice saying to the client, if we don't hear back from you in 7 days, we assume you've given consent? How were you allowing this to happen?
The trustee did that. We did not do that. So this happened in New Quantum's case. So New Quantum did that. They did not seek our approval. We did not know about this until after the event. Recently, they decided to ask us for that, and we did it on a one-off basis. We don't approve negative consent.
So you did do it on a one-off basis?
We did it on a one-off basis after Shield and First Guardian had fallen.
Ferras Merhi declined to be interviewed, but told ABC News every allegation of unlawful conduct that ASIC has made will be strenuously defended in the court proceedings. Liquidators have found that in the case of First Guardian, the assets may be harder to recover. They say that hundreds of millions of dollars was sent offshore. Now, in the case of Shield, the money might be easier to recoup. That's because a lot of the investments were in shares. There's also something called the compensation scheme of last resort. Now, this is for victims of financial misconduct, but it's capped at $150,000 per person. So investors want the government to step in and ensure they protect their retirement savings.
My hope is that ASIC will recover as much money as possible. I also believe that Macquarie Bank and the trustees there also have a responsibility in this. So do the research houses.
A return that could take many years to arrive for those hoping to retire soon.
If you or someone you know is experiencing distress, please contact Lifeline on 13 11 14. And if you need information or support, you can contact Beyond Blue on 1300 22 46 36. Two huge climate announcements dominated the news this week. The National Climate Risk Assessment warned a 2-degree warming scenario by 2050 will cost the economy more than $800 billion. The second saw the Albanese government release its emissions reductions target of 62 to 70% by 2035. The scientific community says it's not ambitious enough, but the Treasurer says it's a golden opportunity. The Director of Climate Energy Finance, Tim Buckley, joined me. Tim Buckley, the National Climate Risk Assessment warned of major economic costs, let alone catastrophic weather events. With the target the government announced this week, has it heeded its own warning?
It's clearly a bit lower than I would have liked. It's a lot lower than what the climate science dictates, but it is a more than doubling of the annual emissions reduction that we've delivered in the last 10 years. It's almost a trebling of what was done in the previous 20 years annually. So it is a big step up. So it's a question, to use the government's comment, it's about what's achievable versus what the climate science says we have to do. And I think they're straddling those two, and they're probably erring on the side of caution. But at the end of the day, they've got to bring the average Australian along who is brainwashed with disinformation, misinformation every day from mainstream media, which is the opposition's busy tearing itself apart, talking about walking away from the Paris Agreement. So if they go too ambitious, ironically, it introduces a bit of investor sovereign risk, because there would potentially be a backlash should the LNP ever get back in power.
And I'll get to the opposition in a second, but the government says on net zero by 2050, the cost of inaction is $1.2 trillion. The cost or benefit of action is $2.2 trillion. So how do you see this playing out economically?
The economics to me are absolutely clear. The problem is financial markets. I mean, that's where I come from. Finance could easily solve this tomorrow if we had the right price. And unfortunately, we're still a decade later dealing with the climate wars, where a price on carbon, a price on the externality, can't be done at speed, at scale, at the seniority that it needs to be. So Europe's got a carbon price of 70 euros. China's got a carbon price of 10 US dollars, so a seventh and eighth of what Europe is. Australia's carbon price is 20 US dollars. So we're a long way from Europe, but Europe needs to actually double to about 150 euros or US dollars by 2035. That's the sort of signal we need. You put 150 euros, 150 US dollars a tonne on carbon, and finance could solve this tomorrow. I have no doubt. There is unlimited capital. I used to work for 17 years in the biggest bank in the world. Capital is not the problem. It's about actually providing the financial signal. It can't just be Jim Chalmers jawboning the finance sector. They actually need to have a price on carbon.
Australia is a huge resources exporter, though. What would a carbon price like that mean for our resources exports industry?
It'd be a bonanza. It would be brilliant for them. I know BHP won't agree with me on that point, but at the end of the day, you can't export green iron if there's no price on embodied decarbonisation. And BHP, Geraldine Slattery, the CEO of BHP Australia, said that straight after the Albanese Green Steel Decarbonisation Roundtable. 6 of the biggest steel companies in the world, 4 of the biggest mining companies in the world, all talking decarbonisation, and BHP walks out of that meeting and says, we're not going to invest because there's no, well, she didn't say the second bit, but they can't invest because there's no price on carbon.
So it sounds like business is leading, but we go back to the political stage and the opposition is in the news for infighting on net zero. It's called the target that the government has released this week a cruel hoax in terms of modelling. What benefit or cost would there be of dumping net zero?
It would be criminal intergenerational inequity for our country, and it would set us back. We'd stay a dig and ship country, and when our key export partners decide that they are going to honour their Paris Agreement commitments, their need for a livable planet, Australia just gets relegated to a third world country. Now, I say that not lightly. We're already designated as one of the least developed, least economically complex economies in the world. The dig and ship has been a phenomenally profitable business for Australia. We have piggybacked on the rise and rise and rise of Asia over the last 2 decades. As the Treasury modelling shows yesterday, that is coming to an end.
Well, the government's most optimistic scenario modelled shows that Australia could become a global exporter of green energy technology. Are you optimistic that we could become that?
I think we've really got to unpack that. We've got to understand it. I am absolutely hopeful that is doable. But as the Treasury modelling highlights, we could reduce world emissions by more than 400 million tonnes a year, world emissions by 400 million tonnes a year by 2050, just in a couple of key commodities, green iron, green ammonia, green aluminium, a couple of commodities, and we could reduce the emissions globally more than the entire Australian emissions today. So we talk about the domestic emissions reduction, and so, yeah, a lot of environmentalists are disappointed, 62 to 70%, but it's the unlocking of investment that decarbonises our exports.
And that's Scope 3 emission.
Scope 3 exported emissions, that's the holy grail. That is the hundreds of millions, like I'm talking $500 billion of investment in the next 10, 20 years. These industries of the future.
Tim Buckley, thank you so much.
Thanks for your time, Alicia.
The chair of the corporate regulator has lashed ANZ for a range of misconduct, which has seen customers and the federal government ripped off. ASIC found evidence of misconduct going back more than a decade, from misreporting bond trading data to ignoring hardship applications and failing to refund fees charged to dead customers. ASIC says ANZ repeatedly breached customers' trust. Rihanna Whitson reports.
A one-word review of ANZ's conduct.
It was grubby. Grubby. That's grubby. It was clearly grubby.
After 4 investigations, the corporate watchdog finds the Big Four bank ripped off its customers for years, as well as the federal government.
Time and time again, ANZ has fallen short. Time and time again, ANZ has betrayed the trust of Australians.
ANZ now faces a whopping $240 million penalty, which requires federal court approval.
These penalties are the highest penalties that ASIC has ever sought in relation to both unconscionable conduct but also in relation to the retail matters.
ANZ misled customers about savings rates. 194,000 accounts weren't paid the correct bonus interest for 11 years. And a further 26,900 signed up to a promotional rate and didn't receive it. The bank also didn't refund fees charged to at least 18,900 dead customers. And it failed to respond to 488 customers who applied for financial hardship. Some waited more than 2 years for the bank to reply.
A vulnerable person who sought help being pursued by debt collectors, that is both traumatic and deeply unacceptable.
The corporate watchdog also found ANZ effectively misled the federal government after it was hired to sell $14 billion of government debt.
ANZ's misconduct potentially made the government $26 million worse off. Money that might have been used to support essential services, including Australia's health and education systems, affecting all Australians. When public funds are put at risk like this, every Australian pays the price.
In a call with investors only, ANZ's leadership claimed the government suffered no financial loss and says the company will repay any money earned. The boss used the penalty to justify 3,500 job losses at the bank.
There have been unacceptable failings. Today's announcement reinforces the fact that change is needed.
As ASIC itself has pointed out, it's now more than 6 years since the Banking Royal Commission, and here we are again. Including this latest record fine, ASIC has brought 11 civil proceedings against ANZ since 2016, with penalties now totalling more than $310 million. Some experts say the bank's executives should pay.
I actually think they should have their bonuses for this particular period cancelled and all clawed back. Why are we allowing anyone to be given an incentive for acting in a way that caused that kind of misconduct?
Customers agree.
Well, it's disgusting. When someone's not doing the right thing, it affects all of us.
Customers, like the corporate regulator, fed up with ongoing bank rot.
To the share market, and it was a negative finish for the week. The ASX 200 lost 1% and the All Ords a little less. Kyle Rodder from Capital.com joined me at the end of the trading week. Donald Trump has had a win this week, stacking the US Federal Reserve Board. His pick, Stephen Miron, is advocating for big rate cuts, including a 50 basis point at the last meeting. What's the market making of the Fed outlook?
Well, it could be argued that Miron is being used as a little bit of a barometer for future policy and, of course, being treated as effectively a proxy for the White House's intentions when it comes to monetary policy. Effectively, if you looked at the summary of economic projections released with this decision, obviously not only did Miron vote for a 50 basis point cut, but it's almost certain that he was advocating for a policy rate below 3% next year, which is, for starters, somewhere around where market expectations are, but well below, I should say, where other Fed members have projected the federal funds rate to be, and well into stimulatory territory. So I think it's actually one of the reasons why we saw equities rally at the end of this week, is that they're seeing Miron's vote as being a little bit of an indicator of who may replace Governor Powell halfway through next year, and the potential of quite accommodative policy settings.
It doesn't take much for Wall Street to hit records, but it keeps hitting them. Why? Is that just to do with interest rates?
One thing that the Fed did do in quite a concrete fashion is indicate that it is likely to cut interest rates twice more, once at the final two meetings of the year, which the markets have welcomed. There's the other element, to that monetary policy side of the story of, the potential of a very dovish Fed governor next year, or Fed chairperson, I should say, next year. On top of that, though, it's a concentrated market. Tech earnings have been fabulous. The Magnificent Seven earnings growth was in the high 20% range again in the last earnings season, far exceeded expectations. And we've got really suppressed volatility at the moment. So, effectively markets are feeling confident, arguably complacent enough to put money to work in equities. So all of those things are kind of really aligning to push the market higher. It's not without risk. Valuations are still very stretched, and there is that argument that there is a degree of complacency there. But all of those things are basically tailwinds at the moment for the market and keep this bull market running on Wall Street.
And at the same time, the US dollar is down 10% this year.
It is, and that's sort of a multi-factor thing, the sort of end of, the US exceptionalism that we arguably saw there from an economic standpoint or economic performance standpoint for a couple of years. But there's also the fears around sort of institutional trust in the United States and that kind of de-dollarization narrative, which, can sometimes be over-egged, but at the margins certainly exists. There's also other, reasons outside the United States that the dollar has depreciated. The remilitarization of Europe, especially Germany, and Germany using its ample fiscal space to pump money into Europe's economy, that it has helped the euro appreciate. Even if you look at things of developments this week, where the Bank of Japan could be on the cusp of cutting interest rates and tightening policy even further, that's supporting the yen as well. So again, there's multi-factors there, but certainly the dollar has been a major underperformer, albeit at the back end of last week we did see a little bit of a pop following the Fed decision.
Kyle Rodder, thank you so much.
Thank you.
A will is supposed to offer peace of mind for families before the death of a loved one, but it can lead to bitter disputes. With property prices rising and the share market resetting record highs, people are increasingly contesting wills to get a slice of a deceased relative's estate. David Taylor reports.
It's been a rough few years for the Brigden family. Tim's mother and father died within 6 months of each other.
There's no siblings fighting me on this. Nobody's staking a claim here.
Lawyers like Simone Hargreaves pick up the pieces when estate planning and inheritance comes unstuck. And she says she's never been so busy.
The rate of people passing intestate, that is without a will in place, is growing. So the data used to be around 49%. It looks like it's definitely heading north of that and sitting around 60%.
A legally binding will must be signed in front of 2 independent witnesses. If someone's superannuation is included in their will, that'll supersede any claims from beneficiaries listed with their super fund.
Having a will in place can really create a lot of clarity and control over who is actually going to receive the assets of the deceased person.
Estate planning lawyer Rowdy Johnson says wills must keep up to date with changes to state-based laws.
That's definitely made people more aware of the wealth that they have and seeking advice on how to protect that or how to make sure that it passes the way they want it to.
But lawyers say it's the online, DIY or do-it-yourself will that's causing the most problems for families. There is legislation in each of the states and territories where a will can be challenged, perhaps because the family member didn't in fact own the asset they're seeking to pass on in their name.
And that's all from Close of Business. I'm Alicia Barry. Thanks for watching.